So they buy all of these treasuries at 1.5 points.
So they got, and let's say they bought $1,000 of treasuries and is paying 1.5%.
Okay.
And they stick them on their balance sheet, and the Treasury pays them every 6 months. They pay them interest, and that's it. They're done. It just sits there. Then the Federal Reserve, to tamp down inflation, starts raising interest rates at the fastest rate of increase that they've ever done. In 1 year, they raise rates about 5%. And as a result, the value of that treasury, which was a 10-year treasury at 1.5%, dropped because interest rates went up. And someone could buy a 10-year treasury 1 year into the Fed rate increases with a 4% return, or they could buy this one for a 1.5% return. They'd buy the 4% because it's a better deal. So the value of the one that the bank held went down. And that reduction in value, it's called impairment. That impairment is reflected on the bank's balance sheet as a loss. That loss was kind of unnoticed until...
Even though it's not a loss yet.
Yeah, and by the way, it never will be, because if they hold that bond for 10 years...
They get it back.
They get 100% back.
Plus 1.5%.
Correct.